Imagine a company that once defined modern smartphones, a company that stood as the gold standard, the one every competitor measured against, suddenly struggling to keep its dominance. That company is Apple. The launch of the iPhone 17 didn't just miss expectations, it exposed deeper, structural weaknesses that investors, consumers, and competitors can no longer ignore. Within weeks of its release, Apple lost nearly $200 billion in market value. Its stock dropped by more than 5% in a single trading session, and analysts began questioning the sustainability of its premium model. While some of these losses are temporary, because stock prices fluctuate after big product launches, the underlying issues signaled a quieter but more dangerous decline. But what really caused Apple's decline? The iPhone 17 is only the surface. The real reasons go much deeper, and they might surprise you. For nearly 2 decades, Apple set the pace in smartphones. Design leadership, tight hardware-software integration, and a premium ecosystem that kept customers loyal. The iPhone was shorthand for quality, desirability, and innovation, but markets evolve. Rivals improved, consumer expectations shifted, and the cost of leadership increased dramatically. When the iPhone 17 launched in September 2025, it was supposed to reaffirm Apple's dominance. Instead, the opposite happened. Immediately after the launch, Apple's stock dipped from $218 to $207 per share, wiping out tens of billions in market capitalization. Reports indicated that iPhone 17 pre-orders were down 12% compared to the iPhone 16. In the same quarter, Apple reported a 5% decline in iPhone revenue year over year, marking the 3rd consecutive quarterly drop in its flagship segment. These numbers shook investor confidence, and for many, iPhone 17 became a turning point, not because it failed overnight, but because it revealed deeper weaknesses in Apple's strategy. Apple's dominance was built on a simple formula: iconic industrial design, proprietary silicon chips, best-in-class cameras, and a walled ecosystem of services. This formula worked brilliantly through the iPhone X era, driving record margins and making Apple the first company to hit a $3 trillion valuation. But by 2025, rivals like Samsung, Huawei, and Google had caught up. Chinese brands like Xiaomi and Oppo offered cutting-edge cameras and foldable phones at half the price. Meanwhile, global economic headwinds, inflation, higher financing costs, and slower consumer spending made buyers more selective. Against this backdrop, iPhone 17 was released with high expectations, but the market reacted not to Apple's reputation, but to what buyers could actually see, use, and afford. The iPhone 17 arrived with Apple's newest A19 chip, modest camera tweaks, and a focus on new AI-driven personalization. Marketing highlighted polish, privacy, and longevity, but when the phone hit reviewers' hands, the verdict was cautious, refined, but uninspiring. By launch week, Bloomberg reported that Apple's valuation had fallen by $180 billion in just 5 trading days. Analysts tied this to weak pre-orders, muted enthusiasm, and growing competition. Importantly, some experts noted that not all of this decline was permanent. Some of it reflected short-term stock market volatility rather than long-term fundamentals. Still, the damage to perception was real. Apple's struggles with iPhone 17 weren't about one device. They were about strategy. 1. Pricing. Miscalculation. iPhone 17 Pro Max launched at $1,399, the highest iPhone price ever, in a year when consumers were already tightening budgets. That premium, once justified, now felt excessive compared to Android rivals offering 90% of the experience for half the cost. 2. Incremental innovation. Apple's obsession with refinement meant fewer bold hardware leaps. The iPhone 17's camera upgrades were modest compared to Samsung's 10 times periscope zoom, and its AI features felt conservative next to Google's experimental Gemini-powered AI camera tools. 3. Over-reliance on brand loyalty. Apple assumed that its massive installed base would continue upgrading every 2 years. But with high resale values and longer support windows, many users now hold on to iPhones for 4+ years, weakening the upgrade cycle that fueled Apple's explosive growth. Apple's minimal design language once set it apart. Today, design parity is everywhere. Rivals offer glass aluminum builds, thinner bezels, brighter OLEDs, and variable refresh rates. While Apple's A19 chip leads in raw benchmark numbers, real-world users care more about battery endurance, charging speed, and camera versatility, areas where rivals often outperform. This mismatch means Apple's strength in silicon no longer translates into visible value, and in 2025, visible value is what drives headlines, reviews, and consumer choices. Cameras drive phone purchases. Apple has traditionally excelled at delivering consistent, natural-looking photos. With iPhone 17, improvements in computational photography were subtle, but hardware advances lagged. By contrast, Huawei launched phones with 5 times periscope zoom. Samsung marketed 200-megapixel sensors, and Google used AI to auto-remove reflections and enhance low-light shots. These features dominated social media, while Apple's upgrades felt harder to advertise. Even if Apple's photos were better in subtle ways, perception shifted. The specs race made Apple look cautious. AI was supposed to be iPhone 17's headline. Apple introduced Smart Assist, an on-device AI designed to automate daily tasks. But critics noted its limitations compared to Google Gemini or Microsoft's Copilot. Apple's emphasis on privacy meant less integration with the cloud, reducing functionality. This cautious rollout disappointed younger users accustomed to bold AI features. It reinforced the narrative that Apple was prioritizing safety over ambition. Good for trust, but bad for excitement. Apple has always charged more, justifying it with long-term software support, resale value, and ecosystem lock-in. But now, Android rivals also guarantee 5 to 7 years of updates. Consumers compare specs and see diminishing returns. In markets like India and Southeast Asia, iPhone 17's pricing excluded millions of buyers. Even in Europe, surveys showed 58% of consumers considering switching brands due to Apple's perceived lack of innovation relative to its price. Services revenue, including iCloud, Apple Music, and App Store commissions, reached $22.3 billion in Quarter 3 2025, cushioning hardware declines. But ecosystems are no longer unique. Samsung, Google, and even Chinese OEMs have built cross-device ecosystems. Meanwhile, regulators in the EU forced Apple to allow third-party app stores, threatening one of its highest-margin businesses. Apple's supply chain remains unmatched, but rising labor costs in China, tariffs, and diversification challenges in India increased expenses. Gross margins on iPhone hardware slipped from 42% to 39% year over year, highlighting how difficult it is for Apple to defend profits while charging record-high prices. Apple's privacy built-in campaign impressed regulators and loyalists, but didn't inspire urgency. Meanwhile, Samsung's foldables, Huawei's spec-heavy ads, and Google's viral AI camera demos captured attention. Marketing can't mask incremental progress, and perception affects sales. Samsung undercut Apple on pricing, Google leaned into AI, and Chinese brands bundled devices with accessories and financing. As a result, Apple's global smartphone market share fell from 19% to 17% in 2025, its lowest since 2019. Buyers now delay upgrades and focus on value-for-money features. The average iPhone replacement cycle has stretched to 4.4 years. Social media reviewers amplify rival advantages, making Apple's cautious updates harder to justify. Apple reported $83 billion in revenue in Q3 2025, down from $89 billion in the same quarter of 2024. Net profit fell from $21.7 billion to $19.8 billion. These numbers may not signal collapse, but they reflect stagnation. Importantly, not all of Apple's market losses are permanent. As analysts stressed, some of these losses are temporary. Stock prices fluctuate after launch events, but unless Apple reignites growth, the trend line points downward. Long-term outlook. Apple remains immensely profitable. But the smartphone growth phase is over. The company must transition towards services and AI-driven devices. Whether it can balance privacy with ambition will determine if iPhone regains momentum or if rivals permanently shift the market narrative. The iPhone 17 is not a disaster, but it is a mirror. It reflects the limits of Apple's current strategy: cautious iteration, ultra-premium pricing, and reliance on brand loyalty. Financial markets have already punished the company with valuation losses. Consumers are questioning value, and competitors smell opportunity. The real lesson? Apple must adapt faster than its instincts allow. Otherwise, the very company that defined the modern smartphone could see its cultural and financial leadership quietly fade. Apple built the modern smartphone, but the iPhone 17 shows it's struggling to adapt. To win back momentum, Apple needs to focus on the basics people notice every day: better battery life, faster charging, and stronger camera hardware. It should balance privacy with smart AI features, refine pricing with trade-in deals and regional offers, and evolve its services with bundles, partnerships, and flexible plans. On the hardware side, modular designs and diversified manufacturing can cut costs and speed up updates. For investors, the $180 to $200 billion market dip isn't the biggest danger. The real risk is Apple slowly losing its premium edge. Key numbers to watch are iPhone sales, average selling price, services revenue, and margins. Meanwhile, Samsung and Google are pushing foldables and AI, raising expectations. Apple doesn't need to copy them. It needs to sharpen its own strengths and communicate more clearly. The next 12 months will decide whether Apple reinvents itself or slips into long-term decline.